Welcome and thank you for joining us for BMI's M&A update for the professional and business services industries. BMI-Mergers and Acquisitions is a leading M&A advisory firm. We primarily support business owners nationally in the lower mid-market. My name is Brendon Derr. I'm one of BMI's advisors and a category specialist in professional and business services industries. I've been building and advising firms in this space for more than 20 years. And I'm joined today by Tom Kerchner. Hi, Tom.
Morning, Brendon.
Tom is our co-founder and managing director at BMI. He's been working in and around M&A for his entire career, 40 years, and he's worked with hundreds of businesses during that time, from startup transactions to billion-dollar deals. So why are we here today? Well, if you own a B2B services business that you're thinking about selling someday, we're providing these updates to help inform your thought process and your preparations as you figure out how to move forward. So we're going to start by sharing an overview of recent activity and the outlook for the M&A market in this category. Then we'll move into discussing some ideas we have for business owners around how to maximize your success when you decide to put your business on the market. Just some added clarity as we get started here. By professional and business services, we are generally referring to businesses built on billable expertise. So that includes all types of consultancies, staffing and HR services firms, marketing and advertising firms, outsourcers, and similar types of businesses. So with that being said, Tom, what has the market been showing us lately?
All right. Thanks, Brendon. So if you listen or watch the national business news, you think it's been a gloomy year for M&A. And while that's true for the mega multi-billion-dollar deals, in the middle market where we are, which is, say, companies worth between $5 and $200 million, for sure, volumes are down 2023 and now from 21 and 22. But those years were record volume years. And as you can see from this chart, which shows over 10 years of activity, you can see how 21 and 22 just stand out compared to all the rest. And if you look at 2023, look at it across, compared to pre-COVID especially, it's really a pretty good year from a volume standpoint. So why is this? Interest rates are up, and you would think M&A would be down in our space, but it's not. And the reason is there's a lot of capital available today to deploy. Companies have had very good years. They're flush with cash. I just looked at a chart of the cash that corporations are sitting on right now, and it's the highest level in the last 20 years. So why is that? Tax cuts 2017. A lot of companies have done very well since then with the economy. Despite COVID, a lot of companies have done very well. So they have very strong balance sheets. Private equity raised over $1 trillion globally last year. So there's just a lot of cash available to do transactions. And then if you look at 2024, what's happening in the economy, overall market sentiment is up, not only just M&A, but so there was a lot of talk previously, 22, 23, about a recession. That hasn't happened. The talk hasn't gone away completely, but pretty much we're not hearing it. Expectations are that interest rates are going to go down sometime this year. Still not clear when, but we hope we're done with the interest rates going up. So right now it looks like 2024 will be probably an improvement over 23, which was not a bad year.
Okay, well, that's good to hear. We'll break down a couple of the subsectors here a little bit. I guess what I'll say before we dive in here is we have been hearing some updates, depending on what source you're hearing from, regarding the actual financial performance and earnings of companies in these categories, that things continue to be flat, if not soft, through the first quarter. So we'll have to see how that impacts some of these M&A figures and going forward. But if we look at the same timeline of data that Tom just reviewed in general, across all professional services, we are seeing a bit more of a positive trend line over the past 10 years in terms of deal volume. So we'll see if that continues through 2024. And then if we look at marketing firms, marketing enjoyed a pretty nice year last year in terms of ad spend. Of course, you're lumping more firms into this category than just advertising firms. There's only one real outlier a few years ago here on this chart. Otherwise, the deal volume has sort of kept up with its overall trend line. And then human capital services, which generally includes staffing services, executive placement firms, and some similar tech-enabled services in the HR space. That has shown a little bit more volatility. Typically, that sector is highly impacted by macroeconomic dynamics, which we're certainly in the midst of right now. We have heard that industry is down year over year at this point, but also a sector that tends to be the first one coming back from any downswing in the economy. So we'll see how that lifts things up here. But as you can see in the chart, deal volume and total capital invested has been quite volatile over the last few years. So we'll see what that looks like in going forward. But in addition to that, how about business valuations, Tom? Are we following a similar pattern there, similar trend line?
Yeah, so actually 2023, when it comes to valuations in the professional services space, looked pretty good. But there's more to the story. As you can see from this chart, now there's a lot of numbers here. What we're looking at is this is valuation data for transactions in the professional services space. Key things to look at here is the column with the TEV over EBITDA. That's the transaction value divided by EBITDA. This is how we value most deals, or most deals are valued in the middle market. So EBITDA, for those that don't know, is earnings before interest, taxes, depreciation, and amortization. It's a common measurement in the middle market because it allows an apples-to-apples comparison of companies. Every company has a little bit different capital structure, different interest levels, et cetera. So this is a way to compare companies. So there are, of course, other things to look at when valuing a business, and we're going to talk about those later in upcoming videos. But the common starting point is always EBITDA and a multiple of EBITDA. So we go back to this chart. We're going to show you here all professional services. If you look in the column, the enterprise value divided by EBITDA, you can see that in 2023, it's actually the highest multiple we've seen in the last 10 years. Not terribly out of line with historical, but it's a good number. But, and this is the rest of the story, if you look at the next column over, and you remember from college statistics days, standard deviation, variability around the average, it's higher than it's ever been. You can see on this chart is 3.1. That's 3.1 standard deviations around the average. So in non-statistical terms, where, say, prior to last year, the highest transaction values were here and the lowest were here. This hasn't moved, but the bottoms moved down. So why is that? Why is that variability happening now? The best companies are still getting good offers from good buyers that have cash. They're not affected by interest rates so much. But the less attractive companies, they're still being sold, but they're being bought by companies maybe that are less capital secure. So cost of money factors in, and so they're offering lower prices. So this is why we're seeing this bigger variability right now.
Okay.
Still a very active market, but it's just a little different than what we've seen in the past.
Okay.
If we look at marketing firms on the next chart, you kind of see the same thing. The average EBITDA multiple last year was 6.8 times. But again, the variability was far, far higher than more than double of what the average was over the long term. So in the marketing consulting space, we're seeing the same kind of variability we're seeing in the overall professional services market.
Okay. Well, thank you for that. And what I do continue to see as well is that buying activity is most often being driven by strategically motivated buyers, which at a high level can fit a couple of common profiles. One is that you just have an independent firm who is acquiring a business that has synergies with their existing business, whether they're adding on complementary services, expanding their markets, expanding in a new customer segment, what have you. The other is where you have investment groups involved, and they're establishing platform companies where they're looking to really establish a foundational business of some type, and then acquiring additional businesses to roll into or bolt on to that platform. But anything that you'd add to what you're seeing in transactions?
Well, yeah. So like you said, what we're seeing is definitely more strategic buyers in this space. Last year, strategics, about 60% of the deals were strategics. And some of those strategics are doing multiple transactions, not just buying one company. They're buying two or three 3 companies at a time. So they're some very active buyers out there. But there's also a healthy number of financial buyers in the professional services space. So they're very important too. We're talking about private equity. We're talking about family offices. And I want to point out, and this is something to talk about in the future, there's all kinds of financial buyers. There's all kinds of private equity buyers. We have a database with thousands of private equity, and having to talk to them over the years, there's all types. And that's be a good conversation for the future.
Yeah.
The other thing is the lines are getting blurred between strategic and financial private equity buyers. Private equity companies are now buying, I think you mentioned platform companies. So platform company, once a private equity group has one, they're buying other companies in the industry and adding them on. So they look just like a strategic buyer.
Well, that leads us into our next topic, which is to start unpacking how you as a business owner, for those who are watching, can prepare now to increase the level of interest and valuation when you eventually engage with potential buyers. So I'm going to pull up this visual value framework, which is just a high-level outline of 6 key value drivers in the B2B services space. Or another way to put this, 6 areas through which you have the ability to increase your company's sale price when you go to market. So those 6 areas are, we have our financials, growth, customers, team, operations, and buyers. And we're going to be unpacking those in depth in videos to come in the coming months. But one of the main points here is that 2 companies working in the same space that look very similar in terms of size, scope of services, and so forth, they may end up selling for 2 very different numbers in the marketplace. And that difference is most likely going to be tied to one of these drivers. So there's, of course, a lot to think about here. It's probably already overwhelming. And we'll be covering all these drivers in future videos, so no need to go through it all today. But practically speaking, Tom, for owners who are ready to start thinking through the exit plans today, what would you suggest as some practical first steps to take?
Right. So the first thing, before you dive into all the nitty-gritty, is assess your business kind of from a high-level, holistic view. But don't forget to assess your personal goals. I always say the right time to sell your business is when you're ready. If your business is always ready, the right time is when you're ready. So get outside help for this. New set of eyes, maybe a different perspective when they look at your company, from the eyes of a buyer. So think about your team that you're going to put together. M&A advisor, wealth advisor, your CPA, business attorney, and of course, timing impacts your focus. Your business assessment, with these folks helping you, will guide you, but you'll want to focus on your greatest strengths and your greatest weaknesses. Every business has strengths. Every business has weaknesses. You're not going to fix them all probably, but there's certain ones that really have the biggest payback when you focus on those. So one of the first ones to talk about would certainly be having a positive trend on revenue and profit generation. Strengths and key weaknesses we see often is weak management teams. Buyers typically don't have someone ready to step in and run the business. So the more that you can have that, the more attractive your company's going to look to buyers.
So thank you, Tom, for all of that. And that does wrap us up for what we're covering today. We will continue to release these videos in the months to come, talking about the individual topics that were covered earlier. Feel free to reach out to us directly if you'd like to explore a little bit more about what this means for you, whether you're getting ready to plan for an exit or interested in exploring your business's value. Thanks and have a great day.